Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about being prepared for volatility and negative news over the next, let's call it, period of time, which could be 6, 12, 18, maybe even 24 months. Of course, the media thrives on negativity. So if there's a little bit around, they like to magnify it. As the saying goes in newspapers, if it bleeds, it leads. And the problem is that sometimes it can influence investors and dissuade them from making investments. But the silver lining is that negative sentiment almost always creates attractive long-term investment opportunities, as long as you're looking for them, of course, because it creates mispricing and it creates, fear-led changes in or sell down of assets, etc. So whilst we could be heading into a bit of a tumultuous period of negativity, the reality is if you're a long-term investor, a long-term evidence-based investor, then it could create some great opportunities for you. So that's what I wanted to talk about today. Now let's talk about the first thing, which is inflation. I mean, it's been well documented that inflation is rising in Australia. The current inflation rate is 5.1%. Inflation is a problem globally. If you look at other countries, New Zealand, 6.9%. UK came in last week at 9%. US is 8.3%. So I guess by developed economy perspective, Australia's actually so far not doing too bad. But I guess anyone that's been to a supermarket lately would probably respond by saying, hang on, Stuart, there's lots of goods that have increased by more than 5.1%. So in reality, inflation, I think, is a much greater problem than what the CPI reading will tell us. In fact, I went to, just as a little anecdote, I went to the supermarket last week, which I don't often do, and I mention that just because it just doesn't give me much context to measure, changes in prices. But anyway, I went to a supermarket last week to go and buy an iceberg lettuce. It's not a very exciting story, by the way. Anyway, and I paid $6 for that lettuce, and I thought, that seemed expensive. But again, I didn't have, any experience to measure that against. Anyway, when I got home, I spoke to my wife. I said, $6 for lettuce. And she goes, yeah, that would normally cost $3 or less. And it sort of stuck in my mind, that obviously that's a doubling of prices in that category. Now, inflation can be supply-driven or it could be demand-driven. So demand-driven inflation means that demand for goods and services, say demand for lettuces in this case, is well above normal. And that's because the economy is doing well, maybe wages are rising, we've got more money to spend, unemployment's reduced, etc., etc. Kind of a good place to be in because the economy is really steaming ahead. And in that situation, to cool inflation, what central banks would normally do is increase the interest rate so that I'm spending more money on my mortgage and therefore not buying as many lettuces as I'd otherwise want to do. But inflation can be supply-driven as well. And so when I say supply-driven, that means that demand might be normal, but supply is below normal. And whenever demand exceeds supply, you get price growth. The market is pretty efficient and it'll keep increasing prices until demand reduces to equal supply, and then prices will hold at that level, if you like. So if we go back to the lettuce example, why am I paying $6 for a lettuce other than I'm not very price conscious? Well, if you have a think about it, is it the supermarket that's making a much greater margin? Well, the answer is no, generally. Supermarkets, although they've done well through COVID because higher sales, fewer people going out, etc., their margins really haven't increased and certainly not doubled. Or in fact, a margin would triple, I think, depending on the cost of goods, for prices to double. Anyway, margins haven't really changed. If we have a think about it, well, farmers are paying a lot more for inputs, like, say, fertilizer, for example, has gone through the roof. and that's because commodity prices have increased as well. So there's a good chance that the farmer's not making much more in the way of profit. Neither is the retailer, the supermarket, and I'm the one left holding the bag, paying a higher price for goods. And so if we think about what's driving inflation at this point, because certainly there was some sectors and types of services and goods through lockdowns that were experiencing above average demand. That is absolutely true. Think about furniture, for example, renovation, those sorts of things. There was a greater level of demand during the lockdowns, but lockdowns are over now. And I think the main cause of inflation is supply chains. And there's really three big factors, I think, that are impacting supply chains. First one is commodity prices. So, that goes to the fertilizer story around, where's the increase in fruit and veg, for example. Also, China's lockdowns, that has a big impact on supply chains. So China continued to lock down to deal with their COVID issue. And then obviously the Ukraine-Russian conflict, that has an impact on supply chains and overall sentiment as well. Unfortunately, I don't think increasing interest rates is going to have a big impact on inflation in Australia. I think it'll cool a little bit, but it won't have a really large impact. To sort out the inflation issue in Australia is going to be a painful thing, because essentially what we need to do is reduce demand to below normal levels. And that means that some people, and unfortunately particularly lower income earners, are going to have to make some compromises. Maybe they don't buy as much fresh fruit and vegetable, or maybe they don't heat their house as much as they otherwise would, etc., etc. That's why I say it's a painful process, because really we've got to reduce our demand levels to below normal. So that means that people have to make compromises. I think the good news, the silver lining in it, is that it's temporary. Supply chains will recover eventually. China's the only big geographical country that's going through lockdowns at the moment. There might be other countries, but they're not material. So supply chains will kind of return to normal. But it is a good segue to talk about interest rates. I did a podcast in mid last year to sort of say, look, interest rate expectations are pretty benign. At the time, mid last year, people were thinking interest rates were going to remain low for a long period of time. And I did say in that podcast, I warned people, interest rate expectations can change very quickly. So we shouldn't get seduced into thinking that interest rates will never rise. And here we are today. We were talking about interest rates rising again. And the same commentators that were predicting interest rates weren't going to change for 10 years are now saying interest rates are going to go through the roof. So, I guess it's a little bit of a lesson to drown out the media noise and really base decisions on long-term averages, the evidence and so forth. The reality is that interest rates were reduced to close to zero for a very good reason. The world was in lockdown, Australia was in lockdown, and businesses and individuals were impacted through no fault of their own, right? So interest rates had to come down to zero, help people through that lockdown process. That's done now, and it's very important that interest rates go back to normal levels as quickly as possible, as soon as the economy can afford it. There are negative long-term implications of keeping rates too low. It distorts markets, etc., etc. So the RBA increasing interest rates now, I think, is a good thing. They have to do it. It's best for the country longer term. To what extent they do it is really going to depend on the inflationary thing, because, as I said, you double the pain really by making people pay twice as much for lettuce and then also more for their home loan as well. And you don't want to send it too far, or squeeze people too far, I should say, because it will, or could, and it could still send Australia into a sort of technical shallow recession. The key component here, or the $1 million question, if you like, is what do normal interest rates look like? And really, that's best described as the neutral rate, where it's neither explanatory or contractionary from an economic perspective. The RBA reckons that the neutral rate's probably close to 3.5%, so that's a cash rate. whereas most commentators think it's probably lower than that. And I suspect, just because of indebtedness and interest rate sensitivity, I suspect that's true. That maybe it's somewhere between 2 and 3%. But the caveat being, as long as the economy can afford it, really interest rates need to get back to 2 to 3% as quickly as possible from a long-term perspective. So while we're on the theme of negative news, let's talk about the share market then. I've written a lot and talked a lot on this podcast about, irrational share market valuations. At times there were just some craziness going on in the marketplace. And I suggested it wouldn't last forever. Well, it hasn't. There's certainly been a correction against that from the beginning of the year, and then some tech companies in particular in the US, 80-90% off their all-time highs during the pandemic. And a lot of these companies didn't have any sound fundamentals, profit, cash flow, these sorts of things. I note the US tech index, the Nasdaq's down by around 30% this year. The Nasdaq includes about 3,600 stocks, and almost half of those stocks have fallen by more than 50%. So it's pretty extraordinary. The problem with a re-rating of valuations, like we've just experienced, is it can be a bit messy in that even really good companies, fundamentally sound companies, get caught up in the negativity and the selling down. And some prices of some otherwise fundamentally sound stocks have fallen too, albeit to a much lesser extent. So it certainly seems like the theme of the day at the moment is now fundamentals matter. Who would have known? Things like profitability, strong cash flows, proven business models, sustainable business models, long-term strong balance sheets, all those sorts of things now matter a lot more than they did, say, a year ago. And that's good news for evidence-based investors, particularly investors that are using different types of indexing strategies. And so whilst it might be a bumpy road for the market to sort itself out over the coming months, in the long run, it can create some good investment opportunities. And certainly if you've been tilting towards a value approach towards investing like we have in our business, it's going to pay dividends, most certainly going to pay dividends probably over the next 12 plus months. And so let's talk about the Australian property market then. There's been some predictions of price drops this year as a result of rising interest rates. We're certainly seeing it cool, the property market cool, but it's in relatively good condition. Maybe there's been some minor, 1 or 2 or 3% price drops, but at least at this stage it looks to be holding its own, but certainly changed a lot since 2020 and 2021. Those calendar years were full of optimism and FOMO and so forth. And look, I wrote a blog and podcast mid last year to say, look, I just wouldn't buy a property in this market, which really meant I wouldn't overpay for a property. Well, I'd never overpay for a property. And it seemed like that was the only way to successfully buy property, is if you were prepared to overpay for it during 2020 and 2021. Of course, there's exceptions to that. But as a general observation, I think it's a much more balanced market, and that's really good news for anyone that's interested in buying property. The reality is the best time to buy property is when it's unpopular to do so. Let me say that again. The best time to buy property is when it's really unpopular to do so. So the best time to buy property is when people are actually thinking, or the general wisdom out there is that that's the last asset you'd want to buy. In that sort of environment, property is then the best thing to buy. But it's also the hardest thing to do. So, whilst we might all look back and go, oh, look at that market, it was really negative. Property was selling, let's say cheaply, at a discount, if you like. But if you then look at the number of transactions that occurred, I bet it's below trend, because few people really have the confidence and the discipline, most importantly, to transact in that market. So I think it's very possible that, there's the negative sentiment surrounding property market will continue and maybe even get deeper and stronger. And if that's true, and if you're interested in getting into the property market, it could create the best opportunities for you, but you've got to be obviously diligent. You've got to be diligent in any market, get some good advice, but also realize that you'll be buying in a market where it's going to feel risky. So overall, inflation's high, it's going to cause some pain. Interest rates are rising, and so they should. The stock market is very volatile, and the exuberance around the property market has certainly cooled. Now, it's quite possible that all this negativity might send us into what I might term as a technical recession. Now, I don't say technical recession because that's just 2 quarters of negative GDP growth. When I say technical recession, it could be very shallow in that because I don't think things are going to recover very quickly until the supply chains sort themselves out. And that could take 6 to 12 months or even longer. And so if we do go into a technical recession, I think it will be shallow. The negative growth won't be that negative. And also it will recover relatively quickly after supply chains fix themselves. So over the next 1 to 2 years, I invite you to do 3 things. The first one is expect bad news. So expect volatility, expect negative predictions, expect to feel uncertain through this next period of time. And I think if you prepare yourself for it and you say, yes, I know it's coming, when it hits you, you know it's just the overall theme and a temporary theme and something that obviously the media will push through. Secondly, whilst I think the next period of time will offer us some really attractive medium to long-term investment opportunities, I think equally I could invest through this next period of time, so let's say the next year, and not enjoy any returns. Because of the volatility, because of the uncertainty and so forth, I might invest in something today that I think is going to generate 10% compounding returns over the next 5 years, but it's quite possible that that thing that I invested in today will be the same price or even could be lower in 12 months' time. But don't let that distract you. So don't expect a lot of returns over the next 12 months. Expect a lot of opportunity. And if you take advantage of those opportunities well enough, the returns will follow eventually when the market kind of sorts itself out. And finally, stay the course. Don't get spooked by volatility. Don't get spooked by negative sentiment. Don't get spooked by predictions of a recession, etc., and go and make wholesale changes to your investment strategy. Have the discipline to stay the course. Understand that markets move in cycles, and the factors that have created this situation that we're currently in are temporary. The market will correct, will reweight valuations, that's fine. Supply chains will eventually work themselves out. It's not a permanent issue, that's fine too. Really just stick to the long term, stick to fundamentals, and have the discipline to stick through this period of time. Okay, that's it from me this week. As always, if you enjoy the podcast, please leave a rating where you listen to it. It certainly does help with the rankings and so forth. And until next week, bye for now.